Hi folks, welcome to the Market Profile Educational Series. This is the part 9 in which we start summarizing what we have learned. Now this particular video is all about putting together whatever information we have learned into a sort of framework, just to see how we progress day by day in analyzing how the market is doing. The next videos that will come up, those videos will particularly focus on the volatility aspect, the stock selection aspect, and some notes on how the markets behave in a bracketed or a range bound market versus a trending market. Why this video is important is because, see, the thing is, we have covered so many topics that it becomes difficult beyond a point to use the information that we know. So that is why it is always better to put things into a framework. And in the last video, or maybe not in a video but on the website, I'll upload what I call a cheat sheet. What that sheet is basically is you give points to or scores to what the market is doing, and in the end, when you get a score, you can easily evaluate whether the market is likely to move up or down or stay in a range, when we could sit out, and that sort of thing. That makes it more easier as well, because that cannot be given out in a video, so you'll have to visit the website to take the cheat sheet. Else, in case you're studying on your own and you're using these videos as a supplement, then I don't think you require cheat sheet anyway. You can carry on with whatever experimentation you're doing while learning market profile. Alright, let's begin. Okay, as I've said, we are just going to sum up things here into a framework. And before starting this framework, again, I want to put it out that market profile is a way to know the now. It is not a system that you can use. Although there are many techniques in market profile where you can initiate long trades, short trades, but that's a different matter altogether. At this stage, just know that through market profile, you're knowing what the market is doing now. And I hope for those who have watched the 8 videos, you are able to tell which profile is of which type, whether we are going to have a good day or a good profile, what the market is doing currently, whether it's in a range or it's moving out. I'm sure by watching all those 8 videos, you should have figured it out by now. If not, then please watch it again. Otherwise, this section becomes meaningless for you. Okay? Okay. So I've divided this framework into 5 steps. The step 1 is where we determine what the recent profile types are in the market, whether the market is trending or not, whether the market is in balance or imbalance, and which stage is going on currently. Remember, during the stage analysis, I showed that why identifying a market into stage 1, stage 2, stage 3 and stage 4 is absolutely critical for trading success. Stage 1 is accumulation, stage 2 is the advance of that accumulation, stage 3 is distribution, and stage 4 is the advance down of that distribution, that is, the price comes down. I gave an example of an upcycle. Alright, now step 2 is where we determine the profile opening with respect to the value area. Okay, again, this we have covered in detail, but again, this is important because it shows whether the market is structured for a larger move or a short move. So let me give an example. Let's say the previous value area is at 75 and you see this profile is opening at 78, 79, and you're getting a open drive on this profile. What does it tell you? Instantly tells you get on board. Alright, put a stop at previous value area high, or whatever strategies you may use, just get on board and ride the trend. Okay, so this is how it's useful. Again, the important concept here is whether the price is chasing value or value is chasing price. Remember, in a range bound market, price will always revert back to value. But in a trending market, value will always chase the price because the price moves ahead. And it's just due to human emotions. When we start factoring in good economic conditions or valuations are cheap, we start buying. And when we start buying, the value is left way behind and eventually it catches up. Price is the ultimate indicator. Alright. Step 3 of that framework is we are determining who's in control. We look at initial balance, we look at tails, we look at range extensions, TPO count, we look at rotation factor, what kind of price excesses are being made. This gives us indication of which other time frame trader is in control, which is our primary interest in the market. Step 4, we look at volume nodes, that is high and low volume nodes that we I think learned in tutorial 6, video 6, where we use high volume and low volume areas to determine the resistance and support in the market. And step 5, the application by trader part is it has nothing to do with market profile. It is basically the make of the personality of the trader and how the market profile part fits into his trading plan, etc. So the step 5 is a part which you guys have to explore on your own, or in case you want to help me out in that, either you can again come to the forum and we can discuss it there, or you can contact me on the email address that's given on the forum. I can probably help you out there. But first I will advise you try it on your own, because your personality, your trading type, your comfort level is something only you know. I can never know that. I can just probably guide you in that, but that is something you know. Okay, so now let us look at each step in detail. Okay, so what was step 1? Step 1 was where we determine the recent profile type. Okay, the first thing to look out is whether the market is trending. How do you look for a trending market? There are many ways. One, the value area overlapping, how often the price is getting away from the value, again determining who's in control. So all these steps are actually interlinked. So when you start at one point, you'll probably go in a circle and you'll keep covering all those points again and again. That is how you'll build your concepts. I hope you're getting it. You got to see whether the profiles are in imbalance or in balance, as I told you about the value area concept. Always remember that the balance profiles, where other time frame trader, buyer and seller both are present. They're not giving away too much in terms of price movement. Such profiles will always be wide. Trend profiles are elongated, thin profiles. So instantly when you view them, you just know it, that whether a profile is a balance or imbalance. Look at the previous profiles, how they're shaping up, whether they are elongated. Now, how wide is wide? Well, I'd say it depends on the instrument. If you're trading the Nifty, you can have four columns and still call a profile a trend profile. You see, that means A, B, C and D, and even E can get printed. It's all about how the shape is. It's very relative. I should probably not give out a guideline here on what is a wide profile or a trend profile, because it depends on what kind of market you are. In high volatile markets, the trend profiles will usually be long and elongated, whereas in low volatile markets, the trend profiles may not be that elongated and long in nature, thin in nature, that is. So it depends. It's all relative in that sense. Then the stage analysis is something you can do it visually. I mean, just see whether you're getting whether you're in stage 1, stage 2, what has happened prior to that stage, whether you're in because that defines risk and reward. If you're in beginning of stage 1, your risk is low and reward is maximum. Whereas if you're in stage 3, that is of an uptrend cycle, then your risk is more and reward is minimum. So that is how you can actually position yourself into whether you want to take that trade or you just want to skip it. Okay, so step 2 was, we look at the profile with respect to the value area, previous value area. Now again, through value area placement, now the position of profile with respect to the previous value area will tell you whether there is constant imbalance or balance. Remember, if it's imbalance, you want to be in that market, because either it will go up, go down. As a trader, you'll benefit. All right. Again, when we the second sub point here is about price and value. In our previous tutorials, we saw that price and value never stick at the same point. They are always moving. So you gotta see whether the price is moving away from the value, or the price is chasing the value. uh, these two things are extremely important. If you see the move of Jan 2012, you would see that, and that goes for most markets all over the world. You'd see that markets starting making new highs every day, and the value eventually caught up later. And when the value caught up, that is when distribution started, and we got a correction. We got a slow distribution process between March and April, and finally a leg down in May. Okay, this is how it shapes out. Now you got to look at value area and how wide the value area is. Okay, the more wide the value area, that means the more support range is prevalent in the market. Now let's say traders have bought from 70 to 75. The volumes are good, the value area is of 5 rupees. You know that some strong traders have exchanged securities there, and thus that becomes a very strong value area or a support level for those who want to go long. All right. And one thing I want to emphasize again and again: value area is the key in market profile. Value area is a visual description of how much money the other time frame trader is bringing. If the value area constantly moves up or constantly moves down, you know that OTF is present, and you have to be on that market, or in the market rather. All right. Step 3. Now in step 3, what we do is we got to determine which other time frame trader is in control. Okay, for this, what concepts we have visited? First was the initial balance. Okay, now what we look for initial balance is the trend of initial balance. What does it mean? If every day initial balance is moving up, you clearly know that the trend is up. All right, it goes similarly with value area, but sometimes what happens is value areas overlap. Even in uptrend, they will overlap. So you get a clue from initial balance. You got to mix and match both. Similarly, range extension. Now when a move up is happening, or even when the market is within a range and it has to break out on the upside, you will see that the maximum times range extension happens within the range is on the upside, and then eventually the market will break on the upside. And when the market starts to rally and goes up, you'll eventually see that the range extensions are happening on the upside way more often than they happen on the downside. So you get a clear visual description that the uptrend is in progress. Alright. Now similarly, tails. Remember, in tails, two things were important. One, the length of the tail. Alright. And second is where that tail was forming, whether near the previous value area, previous price high, etc. and so on. So you gotta look at tails too. And usually in rising markets, you will see that the tails will be there. In bull markets, tails will be there on both sides, but usually the buying tails will be more elongated. In bear markets, the case is opposite. You won't have what do you call buying tails more often, but selling tails will be huge in bear markets. It's just because the nature of bear market is very different. Okay. TPO count, as I've said before, don't lay too much emphasis on that, but yes, it does give you a subtle it does give you some information about how many sellers and buyers are present in the system. It's a bit confusing because sometimes it gives conflicting signals. That is why I just use it as a supplement. Don't base your decisions on TPO count. All right. A rotation factor is extremely important. It gives you clues about where the market is likely to go. Remember, a good positive rotation factor which is sustaining day in day out, then you see a retracement where rotation factor is just -1 -2, again you start seeing rotation factors of +5 +6. You know the other time frame buyer is in control. All right. And finally is the price excess. Price excess is extremely important because it basically tells you um, that the termination of trend is near. Now, I don't know how many of you have actually seen a bear market cycle. If you see a bear market cycle, a counter trend up move in that bear market cycle is usually terminated by a price excess. That is an island reversal, or, or just keep that concept of island reversal. It may not be the actual the actual bookish way of island reversal panning out, but lay more focus on emphasis on the concepts. Okay. Okay, now we come to step 4, um, which is the high and low volume areas. Remember, let's say we from step 1 to step 3 we determine that the market is in an uptrend. What do we do next? Now, one of the effective ways of trading that uptrend is let the market rally a bit, let it come down and take support at a high volume node. Around that, if you see again the price begins to move up, enter that market, because then you know that the trend is strong. The market is gonna hit a new near time high again, and you want to ride that trend out. Okay. Similarly, the importance of low volume areas, you got to see how many times low volume area is being crossed, because remember, low volume area means low activity, and low activity usually happens on trend phases in the market. When the market is rotating at a particular level, volumes will always be high. So whenever market takes out a low volume area uh, resistance or support, it's always important for a trader to see. All right. Last thing to see in this is price location. All right. At which location the price is with respect to the high volume and low volume area. Now, price when it trades usually around the high volume area, what does it suggest? It suggests that the market is in a bracketed mode, because see, when the price keeps rotating in an area, that means the market is not trending. All right. Price will always stay in an area and form huge volumes. That is how markets work. Whereas in trending markets, prices will just go away from a volume zone and will leave a very low volume trail behind. All right. Yeah. The last step is the application by trader phase. Now, remember one thing, that whatever concepts we have discussed in market profile, they apply to they should be used in context of your current system. If you're a new trader, I would rather suggest that you take the concepts from market profile and start building something where you can use market profile and that system together. Market profile can be a great confirmational tool. It can tell you what is going on currently in the market. um, and I believe it's kind of forecasting too. I mean, if you see a strong trend in the market, if you know that the market is going to be range bound, you can have some different strategies to cope up with it. If you know the market is in trending phase, you can have different strategies to cope up with it. All right. It's like I said, it's a decision supporting tool. It's not the ultimate tool that you gotta look out for. So like we have seen in tutorials also, it does help you a lot when, let's say, you're trading crossovers or breakouts, and you know that the market is in a trending phase. You know that breakout or that crossover can be actually sustainable, or it can be more reliable, and that makes a huge difference, because remember, trading 90% it's all about confidence, 10% it's about your system and your technique and your understanding, but 90% trading is all about confidence, understanding yourself, your risk reward. Missing out on those aspects will push you back a lot. So do not forget to pay attention to that. All right. Yeah. This was a pretty small video. It was only because I just wanted to summarize whatever information we have gathered or learned till now into a proper framework. The next two videos which are going to come up will be the concluding video parts of this series. By the end of it, along with those videos, I'm going to show you how you got to use market profile in different market conditions, because in high volatile conditions market profile is a bit different, and in low volatile conditions market profile isn't different. And similarly, I'll go into stock selections, because an index with market profile, you'll get something like 2-3 movements in a year. But if you trade a high beta stock, which is extremely risky, if you're not accustomed to huge volatile swings, can yield you better results with market profile. All right. So see you guys until next time.